All right, let's take it through to some of the experts joining us this evening to get more perspective on market movement going forward. And joining us this evening are Ben Kumar from Seven Investment Management and Amit Nigam, the head of equity at Peerless Mutual Fund. Gentlemen, so good to have you on the show. Starting with you, Ben, then. Seven Investment Management view on oil prices forecast. How do you see it going forward? Because it has already gone past and cracked past the 2008 crisis levels.
Oil is an incredibly difficult market to predict. We've seen that last year in the summer when no one saw it falling from above 100 to below 50. And then we saw it again this year when no one saw it falling from above 50 to below 35, kind of where we are today. The issue is supply. No one's cutting supply just yet. They're all making noises about doing it, and by they all I mean companies, and I do mean nations. There's no one swing provider anymore. OPEC has lost some of its power, the US has lost some of its transitional power, and Russia is also, no longer as powerful a producer. In a world where everyone produces oil, it means no one can swing it quite so much. I think demand's coming through, but it's a lot slower to occur. And when prices are this low, you need a lot more demand to prop the oil markets up. I wouldn't want to say I know a dollar amount, but I think, $35 seems incredibly cheap if it wasn't for the fact that you've got Iran and Libya starting to produce oil again. It's really a tough one to call.
Right. Amit Nigam also is joining us from Peerless Mutual Fund. Amit, good evening. Is there a risk of further global worries also resurfacing going forward in the new year? Because last year, or the year gone by, the calendar year, has really been fraught of global risk.
Sure, I think global uncertainties continue. And if I were to look back in the last 12 months, these uncertainties have only increased. But in such scenario, we keep focusing on our philosophy of trying to identify those companies which are running on a good business model, generate good, healthy returns, have free cash flows, and are run by capable and ethical and corporate governance management. Because what we believe that over medium to long term, these are the more important facts which help investors create wealth than focus on the short-term uncertainties in the market.
Right. Ben, what can be done in order to turn the US stocks around? Because last year was a smart rally, but since then there has been some correction.
I don't think anyone needs to do anything to turn US stocks around. I think the fourth quarter earnings, which of course we'll get in sort of January, February time, will prove that the US economy continues to grow in some areas, those consumer-focused ones, and is struggling in other areas. Guess what? Energy and mining are tough to make money in at the moment, and the US companies will see that. I think we've got Facebook, Amazon, Netflix, and Google all doing okay. What we need to see is a broader earnings recovery in US sectors, and I think that will come through after Christmas.
Right, but Ben, tell us whether Apple will really report weaker iPhone sales for this quarter, as its suppliers, including German chipmaker Dialog, have issued profit warnings already.
Yeah, I mean, I think Apple is really, it's struggling because it is so successful, and expectations are so high. People expect it to make billions of pounds, billions of dollars in profit, and it doesn't quite make enough, and they trash the stock. And I think that's unfair. Having said that, iPhone saturation is clearly happening in the market. The next big thing, the Apple Watch, has clearly not taken off in the way they expected it to immediately. So they are casting around for new ideas. I think Apple will continue to make money, continue to sell iPhones, but it may not be the strongest performer over the next year as it hammers out a new kind of strategy. That's okay. Let's let other companies innovate and perform and take some of the heat off Apple.
Right. So market view on current valuations, how do you see that, Amit?
See, 2015 has turned out to be pretty contrary to what expectations we had at the start of the year. We thought that the earnings momentum would carry and the markets accordingly would edge higher. But what has happened, we have seen three continuous quarters of earnings disappointment, and along with this, a lot of policy expectations which were there amongst investors did not materialize, and therefore we have seen the markets come down. Along with this, the global uncertainties have added to those woes, because of which today we trade at about 16 to 17 times 1 year forward, which to me is extremely a good opportunity to look forward for long-term investments. And why I say so, because 2016 to us seems to be panning out much better. If I were to look at the GDP data, we are on a path where the GDP has been increasing. We see the inflation well in control. The interest rates have come down. And we have not seen consumers slow down. So if I were to look at some of the corporate companies where the numbers have been reported and have been disappointment, the reason primarily has been that the consumers have shifted their buying from the listed space to the unlisted space. So for example, if I am buying products from an e-com website, then this e-com website has probably sourced that product either from some other country or maybe from an unlisted player. And that's the reason why the corporate earnings have been a bit disappointing. But overall, I am pretty positive about 2016, wherein we think that the earnings will start improving from this December quarter itself, and we should see markets give good returns next year.
Right. Amit, talking of returns, 2015 almost negative on the Nifty, marginal returns on the broader market. Do you think 2016 will be much more meaningful for investors?
I don't know if I can attach that adjective meaningfully, but my sense is that if the earnings were to recover, and we see a good chance of that happening next year, the markets should give us positive returns in calendar year 2016.
Leave us with your thoughts on some of the specific areas. Say large cap IT has softened out, so has pharma, but autos after a rough patch is witnessing some rebound. Your thoughts?
So if I were to share some broad thesis here, if I were to look at, let's say, the IT sector, to us, some of the large companies, the way we look at them, have become very large in terms of the size, and therefore the growth opportunity available for investors incrementally is not as lucrative as maybe with some smaller companies. Similarly, if I were to look at the auto space, as you referred to, we have always preferred to play that space through the auto ancillary route than the OEM route, for the simple reason that we have found that the well-managed auto ancillary companies have been far more productive with their capital utilization than the large. I'm not saying that the large OEMs have not been, but that we have found that the auto ancillary is a better way to invest in that space.
All right, Amit, we'll let you go on that one. In fact, Ben, to you two gentlemen, both of you, thank you so much for joining us on the show today.
All right, after that big discussion on the markets, up ahead on the show, we will analyze the unrestrained spiral in crude oil.